Welcome to the CPE Study Circle meet on UAE corporate tax. Today we have a very eminent speaker, Mr. Anurag Chadhurvedi and Sandeep Jhunjhunwala. I request our chairman of Bangalore branch to escort Mr. Sandeep Jhunjhunwala onto the dais and hand him over with a floral bouquet. Also, I would like to welcome Mr. Anurag Chaturvedi, who is joining us online. Now I request our chairman to give a welcome address.
Dubai Chapter Chairman Anurag Chaturvedi sir, Sandeep Jhunjhunwala, colleagues in the committee, and my dear members. Happy evening to you all. I welcome you all for the very interesting program on UAE corporate tax. Initially, we discussed. Initially, we thought of having a physical program because it's a very interesting program. UAE wants to introduce a corporate tax in UAE in 2023 June. For that, a lot of aspirants from India also interested to set up practice in Dubai. This was the right time. We want to have experts, those are already having a practice in Dubai, to hear from them. Then initially, Anurag sir had an urgent meeting. He had traveled back to Dubai. But when we requested, he agreed to join virtually and asked his partner Sandeep sir to join physically here. As we were discussing, it's UAE is planning to implement by June 2023. But there is a saying, those who are practiced in India, company law and any other tax matter, for that matter, they can survey anywhere in the world. Because compared to India and all other countries, it's little easier. That's what he was also opinion, that even UAE tax, corporate tax also a bit easier, and it's a good opportunity for young members, those who want to set up a practice in India. That's why we are having this program. Hope it's a learning session to you all. Happy learning too. And I want to bring a very important other programs we are planning to conduct in this month is, we are planning to have a half-a-day mentorship program for young members. This session is going to be handled by CA Vijay Raja and KL Prashant on Wednesday, and 15th on transfer pricing. I request members to register for this program. Once again, welcome you all for this program. Happy learning. Over teams.
Thank you, Chairman. I would like to take the privilege of introducing today's speakers. Firstly, Mr. C.A. Anurag Chaturvedi, who is a CEO and managing partner of Anderson UAE. For more than 20 years, Anurag has distinguished careers servicing large and complex global clients and has served as a specialist in tax. He is the chairman of the Institute of Chartered Accountants of India, Dubai Chapter Executive Committee. Anurag has also advised global and local business on how direct and indirect taxes impact their business and effective ways to address growing compliance needs. He is the Middle East leader for VAT and custom for Anderson and also board member. He is regularly featured in College Times and the National Boomerang as VAT expert. Anurag is a chartered accountant, fellow international accountant from UK and associate member of CPA Australia. Throughout Anurag's career, he has helped clients address a range of issues, including international tax, strategy, and technology adoption and transformation. His clients have included large multinational organizations spanning the public, retail, hospitality, banking, and aviation industry. With this brief introduction, I welcome you, sir. I would also like to introduce Sandeep Jhunjhunwala, who is currently corporate and M&A tax practice for the firm in Bangalore and emerging law practice for the firm nationally. Mr. Sandeep has spent more than 14 years working with Big Four accounting firms in their tax and regulatory practices. He specializes in the area of corporate international tax with expertise in strategic transaction advisory, cross-border tax structuring, and controversy management. He's also worked closely with regulators and policy formulators in providing inputs to aid the development of new regulations and policies and in assessing their efficacy. He has worked on a number of leading multinational companies in information technology, communication, real estate, pharmaceutical, and e-commerce sectors, and has extensively been involved in advisory, compliance support, planning opportunities and litigation support on tax and regulatory matters. Sandeep has also been an eminent speaker and panelist on tax and regulatory matters at various forums. He is a regular columnist and has written several articles on tax, regulatory matters in business bias and magazines. He is an honorary member of the National Real Estate Development Council and Builder and Real Estate Developers Association of India. He is also a mentor of Government of India startup programs and serves as a mentor for the Direct Tax Committee for the KCA and Ashocham Karnataka Council. Sandeep has recently authored a book on real estate Regulation and Development Act titled Decoding RERA. His areas of specialization include corporate international taxation, merger and acquisition, regulatory and emerging laws. With this brief introduction, I welcome you. Now, firstly, I would like to, or Mr. Sandeep sir, would you like to take the lead? Over to you, sir.
Hi, a very good evening to all the members. I would like to place on record our heartfelt thanks to the committee for allowing us to come over and speak on this new topic. Unfortunately, as Mr. Srinivas said, Anurag, my partner from the Dubai office, could not join. He had some urgent meeting and he had to fly back to Dubai. But I'm here to, set the context first as to why this is important for us as working professionals. UAE doesn't need an introduction from a business destination standpoint. I think all of us know that when it comes to operating a business globally, almost all Forbes 2000 companies will have their offices set up in Dubai. Also, from a FDI and from an ODI standpoint, the UAE is an important destination. If I'm not wrong, UAE almost stands at fourth position as far as FDI is concerned after US, Singapore, and Mauritius. As far as ODI is concerned, it again remains a very significant destination. It is seventh position in terms of the ODI destination that India has. Also, from an expat community perspective, if we look at, there are a lot of Indians, almost close to around 3.5 million Indians who are staying in the UAE region, and a lot of chartered accountants as well who are practicing and who are also working in industry in the UAE region. So per se, it becomes a very, very important destination from a business as well as from a cultural standpoint. Now, talking about taxes, I think UAE has always been known for a no tax destination, but it introduced VAT in 2018. But VAT, all said and done, is a pass-through tax, and therefore there is no impact on the profits of the enterprise. But now with OECD's Pillar 1 and Pillar 2, its emphasis on BEPS, UAE had been one of the 141 signatories who had agreed to introduce the inclusive framework. And that's where it wanted to shed off its no tax destination, no tax jurisdiction tag and introduce the corporate tax. So therefore, the authorities over there have introduced, or they plan to introduce, and they have released some documents which are in the form of concept paper and FAQs, which Anurag is going to deal in detail, to lay out a framework in terms of how the taxes will look like once it is implemented from June next year. And Anurag will talk about the effective timelines. When will be the first filing? I think the first filing will happen in 2025. It will be effective from 23, and maybe he will talk a little bit more about it. And it's a 3-tier structure where there's a 0% which is exempt, there's 9%, and they're talking about 15%, which is the minimum tax, which is also being kind of postulated by the OECD. Now, all said and done, I think 9% is a very moderate rate if you look at the other countries within the Gulf region. And the 5% VAT also, which was introduced by UAE in 2018, that also possibly remains a very moderate and a decent rate considering the other countries like say Bahrain, for example, or Oman and Qatar. So all these countries have corporate tax as well as VAT, and I think 9% is a very decent rate. Now, I would request Anurag to just talk about the key design pointers that we already have in place from the framework that is available. And then whenever there is an opportunity to speak about the India side of things, I mean, we'll talk about branch profits, we'll talk about ODI and FDI structures. So wherever there is an opportunity to chip in for the India side of things, I'll probably do it, or maybe we can do it at the end as well as a summary in terms of how it impacts the Indian structures, both from outbound as well as from an inbound perspective. Over to you, Anurag.
Thank you, Sandeep. Honorable Chairman of the Bangalore chapter of ICI, CA Srinivashi, the entire managing committee of the chapter, and dearest members, good evening to all of you. My sincere apologies to each one of you that I could not join you physically there, although I intended to be there physically to share the perspective out there on the UAE corporate tax. I'm sure I believe that you are all able to I'm audible out there. Is it? Can you hear me?
Yeah, Anurag, you're audible. Please proceed.
Okay. So, friends, I can tell you one thing simple that, in the UAE, this is called land of opportunity. Every time I open my social handle, be it LinkedIn or be it Insta or open my chairman's ID, I receive, plenty of requests with respect to members want to set up their businesses or they want to explore the country UAE as their career destination or probably their professional destination. The reason is simple because UAE is a land of opportunity. It hosts over 200 plus nationalities here, so you can consider it being a world within the entire UAE itself, right? 2018, the first time when the UAE government introduced the value-added tax, post which they have introduced the economic substance regulation along with excise law as well. So at the moment, we can say that essentially in UAE on a verge of bringing a lot of corporate governance by bringing transparencies in doing the way businesses conduct their economic activities in the UAE. So value-added tax, excise tax, economic substance regulations, then anti-money laundering, and then UBO regulation, which is ultimate beneficial ownership structures and whatnot. And then obviously under the OECD guidance, they plan to introduce the corporate tax with effect from 1st June 2023. So what this corporate tax is all about, what is the opportunity exists for all of us, I will definitely share. But before I begin and share about the corporate tax, I wanted to share with all of you that whoever is trying to make the career into the UAE, the common thing that they need to understand is that first you need to understand the culture that this country has. Very important. Please don't undermine this concept of culture, because when you come from India, a city which has established corporate governance for years and ages and ages. However, UAE has corporate governance. It has a different model of operating organization. All organizations that you find here, whether an MNC or a local family-owned businesses or a professional organization, they may be limited in the size. They're not as big as the entities in India where you have thousand, 10,000s of people. You may not find it. So what essentially makes a huge difference that essentially you may be doing a very small part into a particular consulting business, or you may be doing one element within the tax or governance function within the organization that you're operating in. But in UAE, you need to do 360, which means you need to extend your knowledge. If you wanted to look into UAE horizon, you need to extend your knowledge from that small piece to complete piece, because here one person probably do the entire end-to-end things. Like take example of transfer pricing, you may be involved into documentation but not in benchmarking, right? You may be doing initial study, but not getting into documentation or getting into compliance. Or every time you write a CV that, I do litigations, I do multiple things out there. So people need all the specialization, but they need to have people who has complete understanding of the corporate tax or transfer pricing in general. Another thing aspect about UAE is that it is very moderate, modest city itself. So which means you need to work on your appearance and your communication pretty well. You need to be prepared. If you're going for an interview or going for multiple things out there, you need to definitely ensure that you're well prepared. Okay. So this is a certain said about UAE as a thing. And I chair the chapter of ICI Dubai here. We have over 3,000 paid members of ICI here. And essentially, chartered accountant strength within Dubai is over 5,000. Considering Abu Dhabi, it will be nearly 6,500, 7,000 chartered accountants. So there's a great opportunity for professionals like us. So this is the background. So what happened from a standpoint of corporate tax? What happened earlier this year? The Ministry of Finance has issued a public consultation document. So it's called public consultation document, talking about the corporate tax in the UAE. And what this public consultation document briefs, it briefs about the scope of the tax, the rate of taxes, and how the tax is going to function within the UAE itself. So today what I'm going to talk about, I'll share with you the tax basis, its scope, rates, what are the process of registrations, what are the top up tax, exemptions, tax implications, and a little bit about global minimum tax and inclusive approach, what it is all about. So as per the public consultation document, the effective date of corporate tax going to be the 1st June 2023, which means any financial year beginning, any business which has financial year beginning from 1st June 2023, they'll be subject to tax effective from 1st June. So it means if I have a financial year beginning 1st May, it means my tax will fall due. I'm effectively under the corporate tax in 2024 from 1st May 2024. If my year is beginning 1st Jan 2020, 1st Jan to December 31st, then I will be subject to corporate tax from 1st Jan 2024. But what if my year beginning September? So if my year begins September to August, then I'm subject to corporate tax 1st September 2023. So any financial year beginning after 1st June 2023, the corporate tax apply next year, and anything before that, it will gonna go 2024. And what they said that essentially, once your tax year complete, your return deadline will gonna fall after 9 months of completion of the financial year. So if your financial year ends in December, it means September will be the month in which you will be submitting your return after 9 months from the completion of financial year. The similarly one, if you say June to May, then your date is 28th February 2025. And if the year beginning from September to August, then 31st May 2025 is going to be your essential final where you submitting your return. So corporate tax is applicable to the businesses whose financial year beginning on after 1st June 2023. Very important thing here. Here we need to have a little bit focus, friends, because this is where you're going to set the focus upon, and I'll share implications as well going forward. So corporate tax is applicable on business profits, as you all know that minimum alternate tax in India. So business profit means accounting for the net profit of a business after making adjustment for certain item to be specified under CAT, UAE CT law. So any business profit that we generate, which is income minus expenses, is subject to corporate tax. There are certain thresholds, we'll discuss about it. Accounting net profit of a business is amount to be reported as financial statement. So at the moment, UAE follows international financial reporting standard, and as per the consultation document which is called PCD, they say that we'll be following, if a business is following any of the internationally accepted accounting standards, the taxes will be levied on the profit derived as per the international standard. So you may follow US GAAP, you may follow IAS, you may follow IFRS. Any of the standard that you follow, any net profit that you generate or business profit you generate, it will be subject to corporate tax. And important fact here as well, that you'll that you need to keep in mind that there are two set of businesses in the UAE. The first set of business called mainland. Let's say, for example, Bangalore. So Bangalore as a city considered to be a mainland, whereas if you have a specific SEZ, similar nature, I'll define the difference as well. So if you have SEZ, that may consider free zone. So like that SEZ, UAE has 53 free zones. So free zone operate differently than the mainland, and law also distinguishes businesses which is operating out of free zone and mainland. That's why if you see here, the third point, this refers to a financial statement certified by an auditor, tax auditor, licensed in the UAE by the competent authority. So what the public consultation document says that, it says that the free zone entities, the entities which is registered and operate within the free zone, any of the free zone, required to have the audit report certified by an auditor. However, for the mainland entities, which means the entities which is operating in the mainland, there is no requirement to get it certified by an auditor at the moment. And why we'll discuss in due course during the presentation. So let's talk about scope. What is the scope of corporate tax? So corporate carrying on business activities in the UAE with a license, whether in mainland or free zone, are within the scope of UAE corporate tax. Any individual carrying on business activities in the UAE, which means freelancer, social media influencer, are covered under the UAE corporate tax. The third point, individuals who are required to obtain a professional or commercial license under any regulatory authority for the provision of their activities. Now, this is very critical point. Why this is critical? Because at the moment in UAE, like for example in India also, many people, what they do that, they open a Facebook page and they start selling those Facebook page and trying to get the money within themselves. Or many times people are not able to differentiate between the activity which is subject to licensing or activity which is not subject to licensing. Let's say, for example, UAE corporate tax says that any investment into real estate is not subject to corporate tax. Now, what does it mean? It means that I have a property in the UAE and I let out that property to somebody and earn the rent. Will that rent be subject to corporate tax? A lot of debate ongoing on that. So people need to understand one thing, what is business and what is investment. So here is a clear-cut demarcation between investment and a business. Is if you assume the risk and reward associated with the investment, then it's not an investment. The return is not return on investment. Rather is a return on the business that you undertake. For example, if you have invested into a real estate and all the leasing and every single thing is managed by you, then it's no more an investment. It is basically commercial activity that you are undertaking on an ongoing basis. It means any return that is derived out of that will be subject to corporate tax. However, if you take an asset which is part and parcel given to somebody to operate and which has a requisite license and is operating on a charge and giving you return without your being any involvement, that is considered as a return on investment. So that is a little bit about individuals who are required to obtain a professional or commercial license. The fourth point comes non-resident carrying on business in the UAE through any means, which could include any e-commerce entities, which is providing services or goods within the UAE itself. They need to evaluate whether they form a permanent establishment here in the UAE in certain forms. Free zone entities undertaking business activity in the UAE mainland. So by virtue of the free zone, what is the free zones are there? This is called free trade zone or free financial zones out there. The initial idea when these free zones have been set up in the UAE, the idea was that these entities will operate either within the free zone or outside the UAE from the free zone. They were not required to, they were not, allowed to work within the UAE itself. Or if they wanted to work in UAE, they need to have an agent, a person who has due license in the activities of the business which is operating within the free zone. So the free zone entities were only required to register work in the mainland through an agent. So if an entity work within the mainland, it fall within the ambit of corporate tax. And what if it is not operating in the mainland? What if? Every free zone has given a business that for certain number of years, for example, 50 years or 100 years or maybe 25 years, any business which is established within the free zone will not be subject to any corporate tax for the specified number of years. That is what the free zone legislation has. However, everybody is not abiding with the same concept of that doing business in the UAE. So if you are abiding with the free zone regulation, which means you are doing either the business within the free zone or from a free zone to outside UAE, then you will remain outside the scope of corporate tax. However, you will require to register and submit an audited financial statement. Now, next point is a legal person incorporated in foreign jurisdictions who is controlled and managed in the UAE. So if you are a person who's predominantly forming a poem in the UAE, then you will also be falling subject to corporate tax. Limited and general partnership and other incorporated joint venture association of person will be treated as transparent for CD purpose follow through income. They will be having out there. Limited liability partnership will be taxed as UAE resident company. And important point is that all the businesses which is subject to tax in UAE, their worldwide income is subject to tax in the UAE. Worldwide income. When I say worldwide income, means if you have any sort of investment outside as well and doing the income and generating and recording in your books in the UAE, it will be subject to corporate tax. And last point, the free zone entities who did even one transaction with the mainland entity will be subject to corporate tax. Now, important thing here, friends, is that you should know that this location, I mean, you all are conversant with Companies Act, Income Tax Act, and other things. But UAE is a very unique preposition. If you have not worked in UAE, please don't consider that it will be very easy. It's very complex structure, and you need to really understand how the free zone and mainland operation works. And it is very, very complex. So if you consider a career option here, you need to understand the culture. I'll take it back to you. And if you wanted to operate within the UAE from that standpoint, you need to understand how the regulations between free zone and mainland works. So when you come out here for a profession and setting up a business, you need to understand a lot many detail, and it's very complex. I must remind you this. Okay, so let's talk about tax rates. So legal person, the taxable income up to 375,000 dirhams, which is nearly $100,000, is 0% corporate tax, and any taxable income above 375,000 will be 9%. Okay, so it says 9% until 375 is, you can say, zero rate or exempt, you can say. Above 375,000, it's 9%. Large multinational organizations, there is a possibility that they will be subject to more than 9% rate, subject to Pillar 2. So at the moment, what OECD is doing is that they're trying to implement Pillar 2 in various countries. However, United States and Europe, some of the countries are not agreeing to it at the moment. So its implementation is not scheduled at this point in time. What is the effective date of its implementation? However, UAE has given its acceptance that should the Pillar 2 get implemented, UAE will cooperate with OECD and all other countries towards its implementation. So let's say in due course in 2025, it get implemented. What will happen to multinational organization which are having a base in the UAE? So if you have a base in the UAE and you are fulfilling the threshold of 3.15 billion revenue globally as part of MNC, or 750 million euros, if you fulfill that condition, that you fall within the bracket of minimum 15%. And UAE has 9% tax, which means the differential of 15 and 9, somebody need to take it. Either your parent entity, where exactly your income is going to be clubbed, that collect the top-up tax, or UAE itself says that why shouldn't I collect the top-up tax of 7% in the UAE and charge 15%. So that yet to be seen and reflected. The banks At the moment, the banks are subject to corporate tax in the UAE at the respective Emirates level. So foreign banks are subject to tax at a different slab. So it doesn't mean for the banks, it's not new. They are already subject to tax and they pay tax as per slab rates in respective Emirates. So UAE has 7 Emirates. If a bank has a branch in Dubai, it pays a different tax. If it has a branch in Abu Dhabi or Fujairah or Ras Al Khaimah or Oman, Umar Quain, it pays taxes out there depending on the respective Emirates level taxation. However, effective from 1st June 2023, they will be subject to 9%. So let's look into the registration criteria. A business will be required to register for corporate tax purpose and will be required to electronically file one corporate tax return per financial period. So you will be required to file only the corporate tax return once for the entire year within 9 months of completion of your financial year, right? And corporate tax will be payable at the rate of 9% over the income exceeding 375,000 dirhams, which is effectively $100,000. So illustration below, you can see that illustration that, 0 to 375, 0%, and above 375, which is like essentially 25,000, you pay 9%, which is 2250. Okay. So this is like how the tax getting calculated and registration criteria. What happened once the PCD get issued, the Ministry of Finance renders entire responsibility to the Federal Tax Authority. It's called Federal Tax Authority, and its website is tax.gov.ae. It's called tax.gov.ae. So FTA will regulate the corporate tax as well, as they are the regulator for value-added tax, excise, ESR. So it will be the body which will be managing the corporate tax. One important thing that you probably will be knowing for the first time is the tax group. So what happens, in UAE, there are multiple businesses, which means one business, one family owned business, let's say a business, you can say, groups like Reliance in India. They have so many organizations within their umbrella and there's so many entities based on their verticals. And within the vertical, you have multiple organizations. So to have the administrative convenience, the Federal Tax Authority or Ministry of Finance allowed businesses to group multiple entities under one tax registration. That is called the tax group, which means if you have within the cluster 20 entities, subject to certain conditions you fulfill, you can obtain one tax registration for all the 20 entities. It means you need not to submit 20 returns, you can submit only one return on the basis of consolidated income for the entire cluster, should you meet certain conditions. So the grouping conditions are there, which I'll discuss. So key highlights until here that you need to understand: tax on free zone entities. Business established in the free zone will be required to register for CT, which is corporate tax, and submit corporate tax return within 9 months of end of financial year. Free zones are within the purview of corporate tax. However, tax relief may be granted on fulfillment of all eligibility requirement. And what is the eligibility requirement is? They are not doing any business with the mainland. They do business either within the free zone or from free zone to outside the UAE. Free zone will be operating with mainland entities, may not be exempt from corporate tax, as we say that. So this essentially 3 critical criteria which is there, which you need to keep in mind from an UAE standpoint. Now we'll talk about exemptions. So there are certain individuals who are exempt from the corporate tax. The first being is federal and emirate governments, including departments, authorities, and other public institutions. Now, what does it mean? It means organizations like Dubai Police, organizations like Department of Immigration, Department of Economy, Department of Finance, Ministry of Health, or any establishment likewise, Emirates Identity Authority, like this, or any entity subject to they don't do any commercial activity. Second point, wholly owned by government. So if they carry out a souvenir or mandated activity that is listed in the cabinet decision, so they will issue a decision in which if any entity which is wholly owned by the government, like for example, if any of you have been here like Amir or Takif, services that have been provided here. So this could be a wholly owned subsidiary of the government which provides certain services with respect to immigration, or visas or licensing or something like that, if they have been listed in the cabinet decision issued by Ministry of Finance, they might be subject to exemption. The third point is natural resources. The businesses engaged in the extraction and exploitation of UAE natural resources that are subject to Emirates level taxation are outside the purview of corporate tax. Now, who are those people? What are the natural resources in the UAE? Are two, basically gas and oil. So if you are into the extraction and exploitation of natural resources, you will be anyway subject to corporate tax at the Emirates level. So the entities which is extracting oil in Dubai, they are subject to Dubai laws, and entities which is extracting in oil in Abu Dhabi, they are subject to Abu Dhabi taxes. So they are outside the purview of corporate tax. But yet, it need to be seen how. The charities, the charitable organization which is listed in the cabinet decision to be issued will be exempt from corporate tax. Funds, the public and regulated private social security and retirement pension funds are subject to exemption should they meet certain criteria. Now, often when we go out to the clients and whenever we meet our people, so many times people ask the question, is this tax on individuals as well? So when until now I was referring individual as per the income tax law, which could be an individual, legal or natural person. Now I'll be talking about natural person. So whether there's a tax on salaries. My question to you will be partially yes. I will be surprised why partially yes. In the UAE, since as I said that the 200 nationality lives in here, so not necessarily everybody works on the labor contract. There are various people who work contractually and not necessarily under the labor agreement. So like unlike in India, you make an offer letter and that offer letter is not generally registered. So you get your social security number, PPF number. But in the UAE, whenever a person get a job, it has to obtain a labor registration. So if you are under a labor registration, all your income that have been paid by the organization to you is outside the purview because it is not a tax on an individual, on a natural person. However, if you work under a consulting agreement, which means you have not taken a labor and you're working in your consulting agreement with somebody, then it will be considered as a you are required to obtain a license to work as a freelancer, for example. So if it is a labor driven salary, it is outside the preview. However, if it is a consulting nature engagement where exactly you are not under the labor contract, it may be subject to corporate tax. You need to see. You may fall within the social media influencer and freelancers out there. Investment real estate for rental or otherwise, like Airbnb. The investment real estate by individuals in their capacity should not be subject to CT provided the individual is not registered to obtain a commercial license, which I have already explained to you. Exhibitors. In Dubai, if you're aware about in UAE, there's a number of exhibitions happens. Throughout 365 days, we have over 300 exhibitions in different part of the world, the places out there. So every day there is something or other, which means a lot of artists travel here for shows, for appearance, for media endorsement and whatnot. Anybody who earns income in the UAE will be subject to corporate tax, which means now they need to see whether they form the permanent establishment in the UAE. Investors will not be subject to UAE corporate tax on dividend, capital gain, and other income earned from owning shares, securities in their personal capacity. And income from bank deposits are also exempt because it is considered as a passive income. What is other exempt income? So if you take a snapshot here, domestic dividend, that is exempt. And what is a dividend? Dividend received from domestic companies, including the dividend paid by a free zone person that benefit from 0% CT regime. So which means even the dividend paid by a free zone entity is exempt. The dividend is exempt because it is considered as a passive income. Dividend from the foreign companies also exempt. Domestic capital gain is subject to 0%. because it was exempt. Then they brought out that the tax on the capital gain is 0%. Foreign branch profit, you can have exemption about. So there are two choices about the foreign branch. You can have that foreign branch excluded from the UAE corporate tax, which means neither the expenses pertaining to the branch will be permissible as deductible, nor the income will be considered as a taxable in UAE. Or you can consider the expense as deductible and you can take the foreign tax credit in the UAE. So there are certain things are there. Free zone capital gains. So capital gain on the disposal of shares in free zone person will be exempt from corporate tax. Other income. So income earned by a non-resident from operating or leasing aircraft or ships. That is other income. So those are going to be the exempt income in the UAE. This is an interesting article, and I wish that you all should read about it. So there are two things, two industries which is very specific taxation, where it works very exclusive and very different because of the agreement of ITA and so one is the shipping and one is aviation. In these two industries, the tax work very differently. So I advise each one of you to go through the ITA document in order to understand more in detail about it, because it follows it has a very distinct rule with respect to taxation. So I'll not touch base today on this part, airlines, but I will definitely advise each one of you to read about the taxes on airlines as well as the shipping agency. Follow that ITA guidelines in that relation, considering the time. So I will focus more on a UAE tax perspective today. So let's say whatever we discussed until now, let us see the scenario here. Okay. So what is the effectively managed in the UAE means the scenario number one. So there is a company which is XYZ LLC mainland entity which operate within the Dubai or Abu Dhabi mainland, and it has a BVI entity, non-tax regime. It has a separate subsidiary. BVI entity makes a payment of dividend to the UAE entity. However, in this scenario, it is very important to understand who is making the decision, where the directors of the BVI company sits. The director of the BVI company sits in the UAE, and all the critical decision making with respect to BVI entity happens in the UAE. Which means now it has a place of effective management in the UAE, hence a corporate tax of 9% may be applicable to the dividend payment as well. It is because dividend from the foreign companies and capital gain from sale of shares will be exempted subject to following condition. You see here, investee company is subject to corporate tax or equivalent at a rate of 9% at least. Now here, you definitely you should have a question in mind. I said in previous slide, the dividend and capital gains, dividend is exempt and capital gain is 0%. The condition is that if the foreign dividend that we are receiving will be exempt, subject to that regime has 9% taxation at least. So if an entity tomorrow, let's say a country like Botswana or countries like BVI, if it introduced a tax of 5%, currently there's no taxation in BVI, but if it introduced 5% tax, even then the dividend received from that entity to the UAE will be subject to 9% because it does not fulfill the condition that the country repatriating the dividend should have at least 9% corporate tax or more. Okay, so that's why the dividend will be subject to 9%. Take another scenario, which is dividend and capital gain mainland entity. So UAE mainland entity, it has number of subsidiaries. One subsidiary, which is UAE entity, it holds 2%. Then in India entities, it holds 4%. And there's a Bahrain entity where it owns 25%. And there's a KSA entity where it owns 51% shareholding. Right? So now what will happen? The dividend will be exempt, the capital gain going to be 9% because shareholding is less than 5%. So if the shareholding in any of the subsidiary of the UAE entity is less than 5%, then dividend is going to be exempt. However, the capital gain going to be 9% since the UAE dividend is there. Now take the second scenario. the UAE mainland entity owns 4% in India entity. 4% of the shareholding. Again, it is less than 5%. Hence, the dividend is 9% taxable and capital gain is also 9% because it's a foreign entity. Another example, the Bahrain entity where the tax rate is nil and UAE entity is holding 25%, which is more than 5%. Now again, the tax is going to be dividend 9%, capital gain 9% because tax rate in the country Bahrain is less than 9%. Now take the last scenario where the UAE entity holds 51% of the KSA entity. The tax rate in KSA is 20%, hence the dividend is exempt and capital gain is also zero rated and exempt. Take scenario number 3. The corporate tax on free zone entity. So I have a free zone entity which deals into services and goods, and it also has a passive income which is royalty. Okay. Now, when the free zone entity, it has group entity. The free zone entity has a group entity UAE, 0% corporate tax. Goods third party clearance by TP, again CT 0%. Mainland branch, separate set of books it maintains, corporate tax 9%, and passive income, corporate tax 0%. Now, what does this passive income means here? What is the passive income? The passive income is essentially means I'm not doing any additional activity to earn that income. So predominantly, let's say it is one of the licensing income that I get on certain IP, which is, I mean, I'm operating my business of IT related activities into the free zone and outside UAE, but I also earn some sort of royalty from the UAE on licensing part. Now that is a passive income. Another passive income is basically dividend on investment that I made in the UAE bank. So if they are giving any interest on the deposit that I have, again a passive income that is there. Or maybe return on investment that I'm getting out there from a UAE business is again exempt. Now, if a free zone generate active income from a third party, any active income from third party, then what will happen? The entire tax is subject to 9%. So group entity, third party, passive income, active income is all subject to 9%. Take another scenario of capital gain and dividend from free zone. So there's a mainland entity that has an FZCO company number 1, where it owns 80%, and FZCO2, which is free zone company 2, where it owns 90%. So dividend and capital gain is exempt on this, which is, and free zone branch income from the outside UAE again 0%. Now let's take scenario is that if any of the group entity in free zone generate income from the operations other than dividend. Okay, so there's another company free zone income from the operations, which means now what I'm trying to explain here that a group entity UAE has a group entity which has free zone 1 and free zone 2, and what it does, the free zone entity 1 and 2 only gives the dividend. Then all these dividend and capital gain is exempt. However, if the third entity opens free zone 3 and it has income from the operations in the UAE, then the dividend is exempt, capital gain is 9%. And so this is what the scenario is. What I'm trying to explain through these scenarios to you all friends, that UAE corporate tax is very, I mean, between the free zone and mainland, there's going to be much complex transaction that happens, and the entire tax law criticality is on this area, critical, right? So it requires a lot of planning, a lot of understanding, a lot of understanding of how the UAE operation works. You all require that. We'll be having non-deductible expenses. So as we know that within the corporate tax, all my expenses related to the economic activity that I perform in the UAE are deductible. However, certain things will not be deductible. So number first is, which will be surprised to know that you read this very clearly. The related party payments made to a free zone person, that is tax is 0% on receipt of income, will not be deductible. Now, what does it mean? It means that I receive a good. So in the previous scenario, you see that I do a group transaction. So I have a entity in the free zone and I have entity in the mainland. If I'm making payment to free zone for certain things, okay, then this payment is not a deductible expense if I claim it, because free zone entity is subject to 0% tax. So any payment made by an entity to a free zone entity will not be deductible expense. Why this is so? Because many times what happens, the free zone entity sold any goods out there and it declared, let's say, I didn't sell the goods, probably I done a transaction of loan. Just say any payment that you made to the free zone entity from the mainland is not subject to deduction, which means although you can do the trade, but it is not a deductible expenses because it is not subject to tax there. The 50% of the expenditure incurred to entertain customers, shareholders, suppliers, and other business partners. So your entertainment expenses will be deduction up to 50% of actuals. And third one is administrative penalties, recoverable VAT, donations paid to organization that is not approved charity and public benefit organization. So your donations and charity will not be deductible should it not be to an approved agency. And any administrative penalty that you pay. So many times people ask about how about the traffic fines. Now the traffic fines is, if it is on the business, it will not be recoverable. And fines on VAT as well. It's interesting, like, from a planning perspective, as you all might be thinking about that, what is there for the tax professionals? The tax professional will have an opportunity to provide and guide businesses that how they can effectively manage their ETR. So ETR stands for effective tax rate, and effective tax rate can be derived with a number of permutation combinations. So first being is, you see in the structure part, so you can advise your client that how effectively you should design your structure in order to harness the minimal tax on the business which is happening in the UAE, and how you carve out the business which is happening outside the UAE. So you can carve out, you can do written planning on that side of things. And another thing that you can see that I can bring out now the debt into the business. So what the debt will gonna do, it will gonna reduce your ETR by 3%. So what is the tax? What is the income subject to tax? Is EBITDA, right? EBITDA is subject to tax at 9%. And what the PCD says that your interest expense can be allowed as deductible up to 30% of your EBITDA, which is closely 1/3, right? We can say that 1/3. So essentially 30% of your EBITDA is not subject to tax. So 70% into 9, 6.3% is what effective rate of taxation is, right? So you can now plan out there that you can bring out the debt to the maximum in order to take the benefit. Now many businesses has that amount of debt where there's expenses, the finance expenses are there. However, these expenses are in excess of 30% of EBITDA sometime. So how effectively you should advise your clients and your businesses to take the benefit of this rule as well. So 30% of the business earning before interest EBITDA is subject to deduction. Provision to deduct a certain amount of net interest expenditure irrespective of the interest deductibility. So they may come up with certain capping rules, but it is very hard to have that capping rules here because it's a real estate driven or oil and gas driven where capex is very high. So finding out that capping rules on a maximum threshold is yet to be seen. So PCD says 30%, or they may propose certain amount. The interest capping rules will not apply to the banks, insurance businesses, and certain other regulated financial service entities and business carried on by natural persons. So natural person business, which is like sole establishment, may not be subject to this interest capping rules. Consideration is being given to allowing businesses that are part of consolidated group to apply for a different interest capping threshold by reference to group's overall position. So when I say that, essentially in a group, there may be certain conditions linked with varied group, which has like large sizable group is forming a tax group as well. There may be different rule and they will allow to consolidate level interest capping rules, which means not an individual, but overall group entities they will apply. The important point here, last number, is related party interest will only be deductible if there is a valid commercial reason for obtaining the loan. Now, as you all know that the moment we see interest and we hear about interest, we always think about doing the planning like, one entity having a profit, one entity is having a loss, or both entities having a profit. So why shouldn't I, put it out the loan and defer it as much as tax I want? Because financial year is different. So if you have a financial year, you may plan it out in different ways. So please consider that there has to be commercial reason for having the loans out there. Another aspect, losses. So what is a tax loss? A tax loss for corporate tax purpose would arise when a total deduction that a business can claim are greater than the total income for the relevant financial period. And are there any rules for offsetting the tax losses? Yes. The tax losses can be carried forward indefinitely. However, a business can offset a loss in a future periods up to a maximum of 75% of taxable income in each of those future periods. It means today, if you have 100 million loss and next year you have 5 million profit, what will happen? So 3.5 million only you will be able to offset out of 100 million loss. And then balance you can carry forward like that every year. So which means every year you have a profit up to which you can have 75% offset of the loss, and then remaining 25% you need to pay the taxes. Now that doesn't mean that you can't claim a deductions and all. I'm talking about net profit after deducting all these scenarios, including the 375 bracket as well. For a change in ownership exceeding 50%, tax losses may be carried forward if some or similar business is carried on the new owners. Now, acquisitions are pretty normal. Here, mergers are pretty common as well. So what they say that if the shareholding continue to be 50% similar, you can continue to provide. And transfer of losses between companies allowed provided the group companies are 75% commonly owned and not benefiting from 0% corporate tax rate. What does it mean? It means if an entity is having a tax group, anyway, it will provide the net position. But if the entity is not a tax group, however, these entities are 75% commonly owned, which means one person owns both the entities, one 80%, one 75%, or 100%, 179%. And both the entities operate in the mainland, or both the entities operate in mainland and free zone, but both are subject to 9%, then in that case, they can offset the losses within that, though they are not part of same tax group. The tax loss offset cannot exceed 75% taxable income of the company receiving the transferred losses. Again, there is a condition linked with it, 75%. So for 25% you need to pay. No tax loss relief for the losses before the effective tax date, which means any losses incurred prior to 1st June 2023 will not be carried forward. Okay. Some scenarios we can have a look at here. So UAE entity, the profit is 150 million, let's say. 90% it owns mainland entity A, 100% mainland entity B. However, it owns 72% of entity C. And free zone branch, where the profit is again there and it's subject to corporate tax. The condition of group entity is common shareholding of minimum 75%. So what will happen? Now they have another entity D, which is mainland entity, owning 40%. The group profit will be 325 for the profit is here, and the losses, now you see here losses. The set of losses of 243 carry forward 7. So out of 75% of the losses, which is within these entities, they can set up, which is 190%. So they can set up. Rest all losses they can't set up here. I hope this is clear. So 75% 325 is 243. They can set off and carry forward 7. Now, what if elect this free zone entity is elect to tax as 9%? What if? Then my profit will be 343. So profit, my group profit becomes 355 and 75% is 266. And the whole loss can be set off 250. So this is what the condition with respect to set of the losses are there, friends. Another aspect that I want to talk to you about tax grouping. This is very critical aspect as well, and it helps a lot of businesses in terms of planning. The tax group concept, you probably, if anybody who worked in the United States and probably had an opportunity to see that businesses, it exists there. So they brought out this concept from United States, and some of the European jurisdictions also has a tax group concept that is there. So what this concept is, it allows you to obtain a tax registration for multiple entities that is operated part of one group, subject to if the parent entity holds at least 95% of share capital and voting rights and have same financial year. So if the condition is that, we have seen scenario here like this, 90%, 100%, 72, 40. It means this 72 and 40 cannot be part of tax group. However, this entity UAE entity and its entity mainland, that can be part of it. Only 2 entities can be part. Here you can see that where's the tax group I made the broader angle here. So this can be only these 2 entities can be the UAE entity and mainland B entity can be tax group. Rest all can't be because it doesn't meet the threshold for condition. The free zone person that benefit from CT 0% cannot be part of tax group. To form a tax group, a notice signed by parent and subsidiary to be submitted to Federal Tax Authority and 1 tax return consolidated financial statement for the entities in the ground. Elimination of transactions between the group entities. So you will be filing only 1 tax return for the entire group by eliminating the transactions across intergroup. Okay. So here is another scenario. So UAE entity, financial year Jan to December, then it has entity A, B, C, and free zone entity. The financial year Jan to December, Jan to December, Jan to December. Shareholding is 90%, 95%, and third one is a free zone entity. And fourth one is free zone entity. So if I need to see that where exactly the tax group can be there, you see here, mainland entity, shareholding is 100%, CT rate 9%. So you can form this tax group only because although the entity number D has the shareholding 100%, but its the financial year is April to March. So it cannot form a tax group. I hope that clarifies. Now, if the CT branch makes 9%, then it may be subject to corporate tax. So friends, this was about the UAE corporate tax. I'm happy to take a few questions and explain you out there. But before I talk about the pillar 2 impact, which Sandeep can also touch base on that pillar 2. What is the pillar 2? I'm sure many of you might be knowing about it, but those who was not aware about it. So OECD has introduced the minimum alternate effective tax rate of 15% on those organizations which fulfill the criteria of multinational entities, and multinational entities are those which has the turnover of the consolidated group turnover of euro 750 million, or in terms of dirhams 3.15 billion dirhams. So an entity which operates in more than one jurisdiction and has the turnover equal to 750 million euro or more than that, and they consolidate, not combine. Please make my words consolidate, not combine. It means an entity owned by an individual natural person in two different jurisdictions do not form part of this multinational. It has to be a corporate entity which formulated a turnover of 750 million euros or 3.15 billion, and they operate in more than two jurisdictions, either having a separate establishment or having the point as well. 750 million euros. And if they have any of the country, any of the two jurisdictions or more than two jurisdiction, it has the rate less than 15%, then under the pillar 2, the country which is having a less than 15% tax has to collect from this MNC the top up tax, or it need to advise the parent entity in different jurisdiction which has more than 15% tax to collect the top up tax of difference between the two rates, which is 9 and 15.7%. Adopting the pillar 2 proposal does not require countries to change their domestic rules. Adoption could merely mean that companies accept that the country levy a top up tax where the country decide to implement and administer the globe rules. They will have to do so in accordance with the draft rules and guidance to be issued by IF and common approach, you call that. National common. The M&E global turnover 750 million or 3.15 billion AED will be scope of pillar 2. And how does it work? The pillar 2 model rules are designed to ensure large multinational entities pay a minimum level of tax on the income arising in each jurisdictions where they operate. The taxpayer in the scope of rules calculate their ETR for each jurisdiction, having, let's say, the CBCR requirement that you fulfill. So you make the local file and master file, and with a top up tax for each different between the effective tax rate and 15%. So let's say take about UAE, whatever the UAE profit is there, it is subject to 9%. And if you fall within the pillar 2 criteria, then you pay 7% additional to the UAE or your parent entity. And that is called the top up tax. So step forward for the pillar 2. Number 1, constituent entity within the scope. Identify the group within the scope and the location of each constituent entity within the group. Determine the income for each constituent entity. Determine the taxes attributable to the income of the constituent entity. And the fourth one is calculate the effective tax rate of all constituent entity located in the same jurisdiction and determining the testing top up rate. So this is how you're gonna ensure and find it out that how effectively you can look into the pillar 2. So I run through the slide for you to have an understanding about it. Now I'm happy to take some of the questions so that we practically we can exchange our thoughts and ideas about it. I know that it's short, but then the idea was to give you a little bit brief about that. It's how the corporate tax in UAE have been structured. Over to you, Sandeep, from here.
Audible to you?
Yeah.
Okay, so few things maybe I'll just cover from an India perspective as well. You touched upon the dividend and the capital gains which should arise for UAE companies. So more so from an India context, just take up few points. So one is, if there is any dividend which is received from an Indian company, Anurag mentioned that it will not be subject to tax in the UAE, subject to that participation exemption of 5%. So, which is very clear. So, Indian company may have generated profits, paid taxes at the applicable rate, and therefore, when it is streaming upwards the dividends to a UAE entity, it will again not be subject to a tax in the UAE, subject to UAE holding which is 5%, which is the participation exemption, and I think it's a general phenomenon there. But what is important and a little, ambiguous area is about capital gains. It says, capital gains arising from the sale of shares of an Indian company will not be subject to corporate tax in UAE, again subject to the 5% holding. And such Indian company is subject to at least 9% corporate tax in India. So I'm trying to contemplate about a scenario where the Indian company may be a loss-making company. We have many of our startups which are loss-making, but obviously their value is run into millions. Now, therefore, how do we interpret the situation where we say such Indian companies subject to at least 9% corporate tax rate in India not very clear, because though I know that it's not an exempt situation, but the Indian company has been incurring losses and therefore has not paid 9% taxes. So whether it will fulfill that condition and therefore get exempt in the hands of the UAE company, not very clear. Which I'm not very clear. Anurag, you have any thoughts there to add?
Yeah, so essentially what is happening now, if I can say that, these structures need to be thoroughly analyzed, and this is where the role of professional comes into picture. And because UAE has not experienced the corporate tax until now, so what will gonna happen if you have the subsidiaries in India, or you have a parent entity in India having a subsidiary in UAE? There's going to be a lot much implications that need to be driven out, considering the difference of tax rate within the two countries. And obviously, what also somebody need to understand about the treaty benefit that exists as well, and then within certain more rules that is there. And what has happened that in corporate tax world, which we also need to see that whether there are reciprocal arrangement of the credits that have been defined out there as well or not. So considering all those situations, yes, there are going to be implications with respect to set up the losses out there, because you need to take participation exemption that about the branches in reciprocal way, that if I have a branch in India which has a significant losses, and it is taking a benefit in India about the rate of the losses in India, should I bring that losses and set off here, is yet to be seen about that. Yes, and with respect to capital gains, yes, it is going to be having implications, and based on the shareholding percentage that I have out there. So if my shareholding criteria meets, and other group entities are not subject to exemptions, yes, I may take some of the benefits. But if it is I'm not able to meet the criteria of the shareholding, then definitely I need to have implications of corporate tax in the UAE at 9%.
Right. Now, another situation is about the related party interest statement. Again, very crucial from India-UAE standpoint. So it says if a UAE entity obtains a loan from the Indian related entity for any specific intra-group transactions like to pay dividend or to capitalize a group company, then the UAE entity needs to present a valid commercial reason for obtaining the loan in order to claim the interest payment under the UAE laws. Now, what is a valid commercial reason? They have said a valid commercial reason will be considered to exist if the Indian related party is subject to at least 9% tax in India. Again, let's take a scenario where the Indian entity has surplus cash, has not been paying taxes. It's into taxable loss, but has surplus cash. Again, whether it will be subject to fulfill this scenario, I don't think so. So therefore, if we are talking about any intercompany loan from India to a UAE, I think this situation of valid commercial reason has to be tested, becomes very, very important. Next point is about OECD transfer pricing rules. I think that probably should now apply in UAE. So the UAE entities will have to comply with the transfer pricing rules and the documentation requirements, all those arm's length principle supported by adequate documentation that possibly needs to be done on a go forward basis. Now, two scenarios of branches, because we see situations where we have an Indian branch with a UAE head office, or a UAE branch with an Indian head office. I think what it says is, in the case of an Indian branch and a UAE head office, it says profit derived from Indian branches can be claimed as exempt, or foreign tax credit can be availed as per the applicable tax treaties. And this exemption cannot be claimed if the Indian branch is not subject to a sufficient tax, which is 9%, which most possibly will be met because invariably all Indian branches pay taxes at 40% plus applicable
But then,
surcharges.
Sandeep, there may be situation, let's say, for example, certain induction of gift city, for example.
Right.
If some entities are registered out of gift tax city, in those scenario, you may be having this particular situation where the tax is not there, and they're not paying taxes because they are tax exempt, and they're certain, and within SEZ also you are subject to certain exemptions in certain places where you don't pay. So if you come across those scenario where either the condition of 5% shareholding is not met, because there are a lot of global significant investment coming out from UAE where they owns, let's say, 1%, 2% of the capital in terms of startup, as you were mentioning about that, in a startup you owns less than 5%. In those cases also, you'll not be able to set off, that credit, you'll not be able to take that benefit out there. So shareholding condition need to be looked into thoroughly in all the cases.
Now, in a situation of UAE branch, it says profits derived from UAE branches will be subject to a 9% tax, and whatever tax is being paid in UAE, the Indian head office can claim a FTC in India. Again, I think what has been also prevalent currently as well, it says payment of interest, dividend, royalties, and other payments by a UAE entity to an Indian entity will not be subject to withholding. So it says withholding tax at the rate of 0%. That is a condition that probably will continue. And I think one point is on POEM, which is place of effective management. I think not too much of a guidance, at least which is available in the document. It says an Indian entity will be treated as a resident in UAE if it is effectively managed and controlled in the UAE. Now, whether it is getting effectively managed or controlled remains a matter of fact. So, I mean, like in India, we have guidelines, right? Active business test, we look at the asset, number of employees, what kind of passive income. I think those guidelines are, not there currently in the document. It just says, a typical factor to be about the directors and other decision makers, wherever the key management decisions are being taken, that possibly will become the place of effective management. So I think this probably will remain one area where we will have to, as professionals, try and find out whether for a non-resident UAE will become a POEM or not. Yeah,
Yeah,
Anurag.
so I will add a point to this, because in if you see that UAE also a global tax regime now, after the induction of economic substance regulation. So what they silently do, that though they didn't mention about it, they follow the CFC rules. So controlled foreign corporation rules, which laid out your four conditions essentially in any of the country. So four conditions are what? Expenditure, your assets, your minimum income, and a lease, an office. So these four criteria are required to establish a substance. So if the substance is established, you consider to be having a place of effective management from where these substance criteria are met. So this is important thing to be seen. And UAE, what happens? After the introduction of economic substance regulation, people thought initially very easy, but now authorities have started to doing the economic substance regulation audits, on the reports that people have submitted. So here it's very line bound. And when I say line bound, it means you need to understand the law very clearly and implement it. And it's going to be very robust implementation, considering the 5 years of VAT and 5 years of excise and 3 years of economic substance regulation experience that have country gained out there. So they are pretty conversant, and authorities are also geared in relation to tapping those specific transactions. But planning exists. There are ample scope for the planning for people.
All right. Yeah. So those are a few points from my side. If there are any questions, maybe you can take those up.
Yeah.
Can you give the mic? Please?
Hello. Am I audible?
Anurag, is he audible to you?
Yes, yes.
Sure.
So currently, I'm aware that there is a transfer pricing provision applicable for all intercompany transactions. Since there is a process of benchmarking being applicable for any intercompany transaction, what benchmark will it? Right now, we are having actually companies who are doing having a transaction with India and UAE. They are taking Indian entity as a tested party and doing the benchmarking. So how will it happen in UAE? So is there any standard data available which can be used for doing the benchmarking study for under TNM?
So at the moment, there is no specific databases that have been identified. So what we're gonna do that in initial years, it is more likely that we'll be following the neighboring country accepted standards out there. So at the moment, no. But as soon as the transfer pricing kicks in, whatever is acceptable databases are there in tested party transactions at OECD level, that'll prevail out here.
Currently, that means actually any global databases can be used for the benchmarking purposes.
Yeah, yeah.
Okay.
But one has to understand very clearly about this region is very different. So you need to apply your searches and your filters criteria very significantly to the operating conditions prevailing within the UAE. So probably you may need to look into the Saudi Arabia, because Saudi Arabia has METP regulation for a number of years. So you need to probably consider certain databases which is at the moment accepted in the Kingdom of Saudi Arabia. That's the way. And then Oman and Qatar, to the extent you can see that. So these three countries having a TP regulations for quite some time. So if you really wanted to be very specifically aware about, then you can explore some of the databases which is prevailing at the moment in KSA, Oman and Qatar, and to an extent in Egypt as well. Thank you so much for,
Just a sec. Can you hear me?
yeah.
So, do you think is there any advantage if an FPI invests in Indian stocks and derivatives out of UAE? Maybe a free land or a main zone. I mean,
Yeah,
free
so
land.
essentially, those investment, if you're investing out there for a passive income, it does make difference only subject to if it is having economic advantage. From a tax perspective, it makes no difference whether you do in India or any other part of the world, because it's going to be passive income, and passive income is not subject to tax under the corporate tax.
Good evening, Anurag. I hope I'm audible.
Yes, I can hear
Yeah.
you.
Just want to understand, one is the capital gain tax on sale of immovable property in from Dubai perspective. So, though on corporate, and though it is not part of topic on individual who are resident in India, but they are having property in Dubai. So, do we have a separate capital gain tax specifically if it is under corporate or under this?
No, so what has happened, what the PCD says, PCD says that if an anybody, I mean, it says that any person having an investment into real estate and earns the income from the investment, it is not under the corporate tax. So it is outside the scope of corporate tax. So when I say investment, investment means if you have an asset which is immovable asset out there. However, you don't directly manage that asset. Like, for example, I have a property in India, but I never know who's my tenant. It is let out to a person who's a real estate agent and he manages the entire property in India. So it is for me an investment income. I don't know who's staying. It is and my real estate agent who gives entire thing. The contract is entered by the real estate agent and he manages the entire thing. However, if on the same time I do directly deal with the tenant and all the contract is made under my name and all the payment is made to me, rather to my real estate agent, then I'm actively engaged into my business. Okay. Then if it is an asset which is actively engaged into the business, obviously the corporate tax and capital gain will gonna kicks into picture. And corporate, the capital gain is 0%. Should you sell within the UAE itself at the moment capital gains are, and the asset is 100% owned by you. So the capital gain is subject to 0% at the moment. But if you sell the capital gains where exactly you don't maintain the shareholding criteria, then it is going to be 9%. So you need to ensure that capital gain is looked into thoroughly based on the shareholding percentage into the asset for the company which is owned by the individual. Or if it is individual only, then there is no corporate tax, capital gain tax anyway.
Thank you.
Thank you so much for your time.
Anurag,
And
there are a few more questions, and the committee is also here. So for the concluding remarks, so please hold on for 5-10 minutes.
okay.
So Anurag, just one more question I had. This is Sridhar here. So in terms of any tax returns, is it been still notified or yet to be notified? The format of the tax returns which needs to be filed in UAE, is it been notified?
No, not yet.
Any-
So what the Federal Tax Authority has done it, they have designed the portal, but that is not available for public at the moment. So we have done quite a few round of testing on that, but that form is not publicly available, so it is under development, and we are waiting for the law, which was expected to be out sometime soon.
Okay. So it will be published in the portal which you mentioned in the initial discussion. That will be out,
Yes,
right?
yes.
Okay. Thank you. Thank you.
Thank you, Anurag sir, and thank you, Mr. Sandeep. It was a very excellent session, and thank you for sharing the insights about the UAE taxation. I think definitely this will inspire many young members to take up this challenge. As a token of appreciation, I request our Bangalore branch chairman to hand over a memento to the speaker as a mark of gratitude and respect. Thank you, members. Thank you for making it convenient to attendance this session, and hope you had an excellent value addition to your knowledge kitty, and hope if some of you are inspired to open an office at Dubai after listening to this, it would be a wonderful tack for us. Thank you. Thank you, everyone. Good night.
Thanks, Anurag.